Hi, this is Wes Johnson with Act Advisors. So the stock market's having a bit of a rough patch right now. So I wanted to give you guys some information to hopefully make you feel a little bit less worried about what's going on out there right now. The all-time high for stocks was about 3 weeks ago, February 19th. Since then, the S&P 500 has dropped about 9.3%. And that's as of Tuesday's close. So we're about 9.3% off the all-time highs. The average year, if you take all the calendar years out there and you look at the average drawdown, the average pullback that we encounter is about a 14% pullback. So we're not near the average. And in 80 something percent of the years, we get at least a 10% correction. So going through a 10% pullback, while it's not fun, it's completely normal. Now we have been a little bit spoiled lately. Last year, the S&P 500 made about 25%. And it did not have a 10% correction. I think we had a very quick 8.5% bump in the road in August, but otherwise we had very little volatility last year. So, when you factor in very little volatility last year and really big returns, the law of averages was kind of stacked against us. It's pretty reasonable to expect that we're going to have a bump in the road this year, and it might be a big bump in the road. But so far, 9.3% off the all-time highs. We're still not even at the average. Now, we don't know if this is going to be a 10%, 15% bump in the road. Nobody knows how big of a bump in the road it is, but it is normal so far, at least. Now, we are constantly assessing what do we think is the chance of a recession when we get one of these pullbacks. And we get research from a number of sources, and none of them are suggesting that a recession is imminent. We did have one research partner. They lowered their GDP forecast for this year from 2% down to 1.5%, but that's still a long way from a recession. So, if there's not a recession, it's probably just a long overdue bump in the road. There is a little good news, and that is that the bond side of your portfolio is doing its job. It's going up more than normal while stocks are going down. That's how it's supposed to work. That's how it's worked for 100 years, except for the last 2 or 3 years. Last 2 or 3 years, they've both gone down together. It's not how it's supposed to work. So the good news is we're back to stocks and bonds kind of going opposite of each other. So, if you're in a mix of stocks and bonds, you've got something in your account that's going up. So if you want to find a silver lining in this whole rough patch that we're in, if you're still working and you're adding to your investments, your 401k, you're buying while it's low. On the other hand, if you are retired and you're living on your money, this is certainly a much scarier scenario to go through, but just know we get to choose what we're going to sell when we send you money. So right now, we're just not selling from the stock side of the portfolio. We want to sell stuff that's high. We don't want to sell while things are down. So we're selling from the bond side of your portfolio in order to free up cash to send you. So you don't need to cancel your vacation plans. You don't need to do anything differently. We will handle where to pull the money from in order to send you your cash. But in the grand scheme of things, what we're going through is not unreasonable at all, especially given the really good return from the last couple of years and the less than normal volatility we've had. So, just hang in there. We're still in very normal territory, and just know we're managing the portfolios where we will adjust them as they need to be adjusted. So, try not to panic and hang in there. We'll get through it. Thank you.